For a long time, pricing power was one of the clearest signs of a strong business. If a company could raise prices without losing customers, it meant demand was strong, the brand was trusted, and the business had control. Pricing power wasn't just about making more money, it was about dominance. And over the past few years, many companies in the US appeared to have exactly that. Prices went up across the industries. From everyday goods to services to subscriptions, businesses pushed through increases at a pace not seen in years. And for a while, customers accepted it. On the surface, it looked like companies had more pricing power than ever, but underneath, something has started to shift. And it's subtle enough that most people haven't fully noticed it yet. Because while prices are still high, the actual power behind those prices is starting to weaken. This is the hidden shift. To understand it, you have to look at what's changed in the relationship between businesses and customers. During the period of rapid price increases, consumers had limited options. Costs were rising everywhere, so higher prices felt unavoidable. Whether it was groceries, travel, or services, people adjusted because they had to. That gave companies a rare window where they could protect margins by raising prices without immediate pushback. But that environment doesn't last forever. Now customers are adapting. They're becoming more selective, more aware, more willing to change behavior. They're comparing prices more carefully, switching brands more often, delaying purchases, cutting back in areas that feel too expensive. And that behavior is starting to change how pricing works. Companies can still raise prices, but not as easily and not without consequences. That's the first major shift. Pricing power is no longer automatic, it has to be managed. Another important change is how uneven pricing power has become across industries. Not all companies are experiencing the same reality. Some businesses, especially those offering essential products or highly differentiated services, still have strong pricing control. Their customers have fewer alternatives, so price increases remain more manageable. But for many others, especially in competitive or discretionary categories, pricing power is becoming much more fragile. Customers in these areas have options, and they're using them. That creates a split. On one side, companies that can still raise prices with relative confidence. On the other, companies that are starting to feel resistance. And that divide is growing. There's also a shift in how companies themselves are thinking about pricing. In the past, raising prices was often seen as a straightforward way to improve margins. Now it's a more delicate decision because businesses are starting to see the downstream effects. Higher prices can protect short-term profits, but they can also reduce demand over time. They can change customer perception. They can push people toward alternatives. So companies are becoming more cautious. They're testing smaller increases, using targeted pricing instead of broad changes, offering more promotions in certain areas while holding firm in others. Pricing is becoming more strategic and more complex. Another layer to this shift is the role of value perception. Customers today aren't just reacting to price itself, they're reacting to whether they feel the price is justified, and that perception is changing. After years of rising costs, many consumers are starting to question what they're getting for what they pay. If the value isn't clear, they're more likely to pull back. That means companies can't rely on pricing alone. They have to reinforce the value behind it. And if they don't, pricing power weakens, even if demand hasn't fully dropped yet. There's also a timing issue that's becoming more important. During the period of rapid price increases, companies moved quickly and often in sync with broader market trends. Now timing matters more. Raise prices too soon, and you risk pushing customers away. Wait too long, and you risk falling behind competitors or losing margin. So, pricing decisions are becoming more sensitive, more dependent on data, more influenced by short-term signals, and that adds another layer of complexity. Another factor that's quietly affecting pricing power is competition. As markets stabilize and supply chains improve, competition is starting to return in areas where it had temporarily weakened. More supply means more choice for consumers, and more choice reduces pricing power. Even small increases in competition can shift the balance, because when customers have alternatives, they gain leverage, And when customers have leverage, pricing becomes harder to control. There's also an internal pressure inside companies. Costs are still elevated in many areas, even if they're no longer rising as quickly. That puts pressure on margins, so businesses face a difficult balancing act. They need to protect profitability, but they can't rely on aggressive price increases to do it. So they look for other ways: efficiency improvements, cost reductions, operational changes. Pricing is no longer the only lever, and in some cases, it's not the preferred one. What's happening here is a shift from pricing power to pricing discipline. In the past, power meant the ability to raise prices. Now, discipline means knowing when not to, knowing how much is too much, knowing how customers will respond, and that's a more complex skill. It requires a deeper understanding of demand, competition, and behavior. It requires constant adjustment. And it requires accepting that pricing isn't a one-time decision, it's an ongoing strategy. This shift also changes how we interpret business performance. In the past, strong pricing power was a clear signal of strength. Today, it's more nuanced. A company might maintain high prices but still face underlying pressure. Or it might hold prices steady but strengthen its position by retaining customers. So the signals are less obvious. And that's why this shift is easy to miss. Because from the outside, prices are still high, but the dynamics behind those prices are changing. And that change matters. It affects how companies grow, how they compete, how they manage risk, and ultimately how they succeed. Because in today's environment, pricing power isn't just about what you can charge. It's about what customers are willing to accept, and for how long. And that's becoming a moving target. So while the era of easy price increases may not be completely over, it's definitely evolving into something more complex, more fragile, and much more strategic. And that's the hidden shift that's reshaping pricing across American companies.